video I'm going to give you a quick run through of some high risk investments that I suggest that you avoid, or at least think very carefully before getting involved in. So I'll start with some basic ideas that I would like you to consider. The first one is I'd advise you to focus on intrinsic value. That's looking at something and saying, this is the cash flows that it's going to generate, this is a reasonable valuation for it. Buying into very simple businesses that have got very good long-term economics, they're going to generate cash over a long time. That's got lots of intrinsic value, and if you can get it at a decent valuation, you're probably going to do okay. A lot of these high risk investments don't have an intrinsic value, or have an intrinsic value that is very difficult to calculate. You want to understand the idea of market efficiency. That is that prices reflect a lot of the information that's coming into them. A lot of academics would say that they price things in extraordinarily quickly. When new news comes into the market, that's what moves the market, and that is factored in extremely quickly. So you don't want to delude yourself into thinking that you're faster or smarter than everybody else, because you're up against some seriously smart people. Hedge funds spend millions on employing teams of analysts to do constant research. For example, if you're making bets on pharmaceutical stocks, there are people in the city of London or in New York that their entire day is devoted to studying a small number of pharmaceutical stocks. That's all they do, and when you make bets against them, you're suggesting that you know better than someone whose full-time job is a very small sector. You don't want to be seduced by high returns. If something promises high returns, that's a serious warning sign. And if something has the potential for very high returns, usually you're taking on a lot of risk. So if you could get very high returns without taking on a lot of risk, that would be the ideal investment, and everybody would be doing it, and would pull down the returns. And you want to minimize costs, regardless of what you're doing. Whatever you give away in costs is coming out of your profits. So avoiding costs is, regardless if you choose to take on high risk investments or not, costs are always your prime consideration. And black swans, this is an idea put across by Taleb in his book on the subject, which is these big, random, totally unpredictable or almost completely unpredictable events that cause huge effects that you would never see coming and completely change the risks. So if you've got a very high risk portfolio and one of these black swans comes across, you're going to be absolutely wiped out, and you don't see it coming. That's the point. The first investment I would consider a lot higher risk than other people do. Forex trading's become extremely popular for some reason, and I don't particularly like it. Currency markets move very quickly. They adjust to new information extremely quickly. There's a lot of algorithms, these computers that do it at virtually the speed of light. So you're not going to factor in news faster than a lot of these computers. You're up against professionals, people like George Soros, and Quantum Fund, that's the fund that he runs. These huge hedge funds that manage billions, you're up against them. If you trade too frequently, you actually build up quite substantial commissions, which a lot of people forget about. They think Forex is dirt. But if you trade a lot, those brokers are making a lot of money. That's why do you think they get to buy all these advertising? You see these Forex brokers on Bloomberg. There's a lot of money in it, and it's a negative sum game. That is that all the winners and losers exactly cancel out, but you've also got costs. So it's worse than just cancelling out. These contracts for differences, it is betting, it is a form of gambling. You can lose more money than your original investments. You can invest £500, $500, and end up with a bill at the end of it because it's leveraged. Very risky. these random events, black swans, when you're making a bet on a contract for difference,
and it goes completely against you for something totally unforeseen.
You couldn't have calculated that risk in advance, you're going to get destroyed. And brokers love contract for difference. There is a hell of a lot of money to be made doing these. Stock options, you have to remember that the majority of these options expire worthless, and if they expire, whole premium. So you've put up money and you've got none of it left, unless you can sell on the option in between. But usually you'll just lose your premium that you put in, so you'll get 100% loss. The thing with options is you've got a very small chance of a huge upside. When options expire, or rather exercised in the money, you can make enormous amounts of money. But the overwhelming odds are that you're going to lose your premium. And I think investing should be the other way around. You should have a small downside and a good upside, rather than just a small chance of a very big upside. Binary options. These are the worst class of options in my opinion. I hate these with a passion. These, to put it very bluntly, are for suckers. You lose most of the time. They are the very low form of gambling. It is very, very negative sum. Brokers make an absolute killing on this. Because the thing is, when you do the maths, you have to be right 54.5% of the time. So that's more than every second option you buy has to be right over time to stop you losing money. And a lot of these options expire. They are very, very risky investment. And the bottom line, I think, is if you understood these binary options, you wouldn't buy them. And if you don't understand them, you've got no justification for buying them. That's paraphrasing something Buffett said about leverage. If you understood them, you wouldn't buy them, and if you don't understand them, you shouldn't be buying them. So I don't think there is any justification for going to binary options. I've seen binary options where you can bet on where the market's going in the next 5 minutes. I don't really care what you think about market efficiency. Everybody agrees that the market should be pretty efficient within 5 minutes. No one really knows where the market is going in the next 5 minutes. It's ridiculous. Stay away from binary options. Commodities, a lot of people don't consider these nearly as risky, but they actually are. It's very hard to put an intrinsic value on gold, silver, or steel. You know there's going to be a demand for them, but you don't know exactly how to calculate that, and they're producing no cash flow, which makes them a lot more dangerous. They're extremely sensitive to market and economics. They can move very, very quickly, and as I said, they produce no income. So if you lose money buying them, you're not going to have any dividends or things that's going to help you recover. Collectables. The only way that to value collectibles is they are just worth what someone else is going to pay for it, and that's very hard to determine. They're a liquid, so they can be very difficult to sell because you who's looking specifically for that, whereas in stock market you're guaranteed when you put in a sell order it's going to execute very quickly. You've also got costs to pay, so the longer you keep on to these things expecting them to increase in value, you've got to pay for storage and insurance, and they produce no income. Bottom line, the returns in the stock market, buying good companies or buying broad indexes and holding them over time, you'll do fine. You're not smarter than everybody else. A very, very, very small number of people possibly are sufficiently smart to outperform the large number of investors. Read up on George Soros. Stock prices have a random walk. It's very hard to convince people who are new to the stock market that there isn't patterns in the stock prices, and you're up against these Never forget about these algorithmic trading. They're very fast, and they make the market so much more efficient. New information goes so quickly. I don't think you can get up, watch Bloomberg for an hour, come back and beat all these algorithms to the new news that you've seen on Bloomberg. It's a very bad idea. And I'll leave you with a short message from the Dean, which is
your Ben Graham and Dave.
about unintelligent speculation.